personally thank CA Prashanth KL for accepting our request for handling this today's session. Actually, his session was tomorrow, but he has accepted and then helped us. Thank you so much, sir. I request CP Jain to escort the speaker on today's and then welcome him. Floral bouquet. Prashanth KL is a chartered accountant with 19 years of experience. He is a Bachelor of Commerce from Bangalore University. He also holds a Diploma in Information Systems Audit from ICAI. And is a graduate in law. He is a partner with Guru and Jana since 2006. He specializes in indirect tax and direct tax, both domestic and international taxation. He is a co-author of book on international taxation published by CA, co-author of book on GST, Where Did My Profits Go? An illustrative narrative of GST law. He is a speaker in ICAI, DT, RTI, in Indian Tax Department, professional forums. He has presented papers in Dubai, Delhi, ICAI chambers, and in Bangalore branch as well. He heads the training initiative of Guru and Jana and has done VAT implementation for clients in Dubai. With this brief introduction, I present before you CA Prashanth KL. Over to you, sir.
Thank you, sir. Thanks for the generous introduction. Doing the sessions on startups. Of course, it is quite important to go in depth in any of the subjects, and I hope that should give a lot of us doing more of specialized services to the startups as such. So I hope right from the morning about the startups, speakers would have already spoken about various legal requirements or terminologies or the framework. Of course, Guru session on the legal thing. Probably the definitions, most of it is already through during the day. So I would suggest, I will not go into all that. Even if I touch upon the subject, maybe I'll tell broadly some 4 or 5 things about it because you would already know that. In fact, as I speak today, probably we have to learn a little bit more because as far as taxation of the startups is concerned, there are few sections that have made its way into the law, especially for the startups. So those things we can have a look. But otherwise, what is the law that is applicable to startups is the entire tax book. So the entire Income Tax Act is applicable to the startups. So we are not delving into the entire thing. We'll only go into those 4 or 5 aspects. And there would be few financial planning aspects, what I have seen from the experience that I've got with some of the startups that I worked for. So after that, we can discuss maybe a few questions and see how I can answer them. Then we can conclude the session. Hope that flow should be fine for all of us. So the definition of startup, all of us know, but what is recognized for the Income Tax Act is the recognition of the startup by DPIIT as such. So it should be a private company, registered partnership firm or an LLP. And 10 years should not have lapsed from its incorporation. Turnover in any year since incorporation has not exceeded 100 crores. Entity is working towards innovation or it has a scalable business model with high potential for employment generation and wealth creation, not found by splitting or reconstructing the business. Obviously, because we cannot tell just because a startup taxation regime has come and there are possibilities of saving the tax in few sections at least. We cannot say there is an existing business, we'll split that and then just sell it to a new entity and tell it is a new entity, which is not possible. The law is very categorical in telling that if it is formed by splitting or reconstruction of the existing business, it cannot be treated as a startup. Of course, for rest of us who feel that the businessman is new, he has got an entity from another entity, all that is fine for our discussion, but for tax purposes or the schemes that is applicable for startups, it would not be recognized as a startup as such. So that is in brief what is a startup. Now let us see what benefit in the tax the startups can get as such. I'll directly go into the main section, which is section 80 IAC. This is a very funny section. The reason I say funny section is, it is saying tax holiday is 3 consecutive years in a block of 10 years from year of incorporation. And the fun part in startup is first 10 years, none of the startup is making profit. Now, what will we do with the tax holiday? Okay, so in that case, at least let us see, in case, okay, we will start looking at this section. Just in case startup makes a profit, okay, can we now claim section 80IS? By the way, few things are quite interesting as we go in the process of, go in the path of startup legislation. Yeah, we saw which are the entities that can become startup. It's a private limited entity, registered firm, and LLP, correct? Okay, so assume we form a new CA firm. It's a partnership firm. I register it. So to the CA firm, can we take the startup registration? See, always it is like we are thinking about the clients. We have forgotten to think about us. What about us? So CA firm, registered firm, we have formed the firm, partners are there, registered it. Okay, can we go into the startup regime? We'll come there, but before that, let us cross the first step, because 80 IAC, I believe, is applicable only to private limited company and LLP. For a registered firm, it is not there. So if you feel your balance sheet and P&L can be seen by everybody else in the world from downloading your balance sheet from MCA, you can form yourself as an LLP, attempt for a startup registration. Okay, now what is attempting startup registration? Can you tell me the conditions now? So it is talking about innovation. So what innovative way can a CA firm work in its regular daily activities? Okay, let me tell statutory audit, internal audit. What innovation can we bring? You can be adventurous. It's no problem. I mean, just because we tell here we are not going to register, okay, it's okay. But you can. So innovation, what is innovation? Time of doing the audit is not innovation. I think that's an important thing. What we are missing in the CA profession many times is, can we afford to start a tech team in the CA firms? Because without tech we cannot do. With tech, there are humongous possibilities. So I completely take cue from him, and I would just add a little bit more to it, and I'll tell him, in case you build a software in such a way that you're able to probably drill down the data in a more detailed, specific manner, and you're able to get the data more accurately and follow the steps of the sampling or any of the audit procedures what CA Institute or NAFRA or whatever prescribes, and you're able to build that and tell that click, and out of 10 lakh line items, it is able to give the 5 lines and tell you, yes, this is how it is. You tell me, have you not improved the methodology of getting data or the procedure or the process that you were following earlier in order to provide the same service? Agree? Agree? So I'm saying innovation also includes improvising the process. We'll stop CA profession, we'll go to manufacturing entity. You have 10 processes in the manufacturing entity. Some 3 or 4 processes which are critical, of course, you would put innovation into those processes. And that process improves to ensure that the quality of the product and quantity of the product is increased. Okay, as a manufacturing entity, is this innovation? Agreed? Leave manufacturing entity, come to CA firm. Is there anything different that we did here? They manufacture machines, we print on paper. There's no other difference. Right? I mean, I can't use the word we manufacture. We don't manufacture, right? So in case that innovation can be proved, why can't that LLP CA firm become a startup? I'm telling this because it is not that easy to get a startup recognition. I think many of you may know how many startups are there in India, around 50,000, I mean, there are lakhs of them, but which has come to DPIIT and the stage 1 registration has been completed. Okay? Around 50,000, 55,000 startups. Okay, now tell me 80 IAC, how many have got amongst them? Not more than 500. Why is that? In the second stage, when we come for 80 IAC, there is an important step of inter-ministerial board approval. There, the application gets stuck. It is not that easy to go ahead. How would I know? I have suffered in one of the client cases, so I can tell that. So, there was a business which they conceptualized for digitizing and creating new notes and music using guitar, feeding it through the technology, and then it gives several, notes. And that they'll compile, make it into a book that they sell, or they take people on fee and they train them. Now in this business, is innovation there, innovation not there? So, I mean, each of you, some of you tell no, some of you are telling yes. So I understand this is the problem even inter-ministerial board also has faced. This is the exact problem where inter-ministerial board tells, oh, this is not innovation, I don't want to take it as innovation. This is where it is causing the trouble. But the point is, should we stop it? Even a CA firm should try it. I am saying we should not leave. So I was thinking about it and I saw a firm was 20 years old. So I told, okay, not applicable to us. So I just left the idea. So in case new firms are there and it is starting, why not? And if you are able to embrace technology, why not? And when it comes to scalable business model, somebody told not possible. Now you tell me why not possible. So it's very important to understand the last sentence or just before that what Guru was mentioning. We are thinking of doing lot of attest functions. We are leaving a rest of huge amount of ocean of opportunities which is not attest functions, and yet we feel that there's no work. This is where work is. So in case you are able to conceptualize an idea and that you scale, why not? I'm just bringing this aspect to you because if we cannot innovate or we cannot defend our business, how do we defend the business of the client who comes, trusts us, telling that, okay, get me the startup registration, right? I think start thinking about it. It's okay. It's okay. Some of us will apply and we'll see what the inter-ministerial board will say, right? And employment generation, don't we think we can increase the employment generation? Why not? It can be. So it is about how we present ourselves to the board, how we make the project report. Of course, now they have changed. If they see any PDF, they are not happy, they need a video. So some of you have tried doing an inter-ministerial board, the startup registration. Yeah. So you're doing the videos, something like that what he showed and, okay. So if that is not done, they'll feel that, okay, innovation is not there. So the presentation also of the idea is very, very important. Only when that approval comes, that becomes stage 2 approval of it being recognized as a startup. In stage 1, normally what happens, you get that 56 to 7B, that approval you get. But 80 IAC for us to get is where the IMB comes into picture. So that also we have to keep in mind. It's in Delhi, yeah. Then in this, okay, dates are important. Incorporated after 1st April 2016, but on or before 31st March 23. That is what the law tells now. I think as and when each budget comes now, they'll keep adding 1 year. Okay, that's okay. I think probably it will go up to say to 2025 or something like that, 26. We don't know, we'll see that. Many times we get a question from the startup telling that I have been a 5-year startup now, but I forgot to take this registration. What should I do now? Any answers? Pardon me? They can take it because it just tells you have to be in this period, that's all. So you are in 23 does not mean that you have to take it now. So it can be earlier also, and we can take the startup registration now. And once you take the benefit of 80 ISC, we have this problem, new problem that has come, 115 BAA and 115 BAB. In these sections, there are restrictions on claiming the deductions or losses that is arising out of additional depreciation, or few other list of allowances that is there in 115 BAA and BAB. And in case those allowances are claimed or deductions are claimed, then this lower tax rate regime is not applicable to those companies as such. Correct. So that being the case, it is either or. Either you're choosing 80ISC or you're going with 115 BAA, BAB as such, right? Because why that is important to be seen is we have to have probably a business plan, a chart, which tells for the next 10 years, this is how the profitability they are projecting. I mean, everything is based on projection for startup. It is not an easy thing. So there's no other way but to go with projections, test the assumptions that are made and see how far these assumptions can be achieved. Okay, based on only that, we can take a decision, okay, in future, should we go with 80IAC or go with 115 BAA or BAB, those kind of things. Assume you are not able to predict the profit. First 3 years you take the exemption. Later you will feel that I would like to go to 115 BAB. That becomes a difficulty, right? So these choices is what will take a lot of time and effort as such. You can tell nature of business and it has to be. It has to be. At least the documents that we send, the IMB must be able to see, okay, they have an intent to do this innovation. That should be there. In every document, in fact, that goes, it should be there. For the startup, I don't see a 80 IAC. Startup is not allowed, I think. For OPC, it is not allowed. It's a company. I need to check on that. OPC, there are too many restrictions in OPC. Okay. When I update, probably I'll add this slide. I understood the query. Thanks. One important thing, normally, sometimes we forget to tell the client. We'll tell 80 ISC deduction, is there no taxes? Everybody is happy. In the year end, he is filling the IT return when MAT comes. Now, client is telling, from where did this 18% come? You never told me that. Because at the time of talking about startup scheme, it is all about marketing, telling that India has given 3 years of tax exemption. Oh, great. Then year end, you're telling pay MAT. It's finished. So in many cases, there is a miss. This is a catch. We have to be careful because client has, I don't know. I mean, some startup is there, it is making good profit and he feels, give me a good planning where I don't pay tax. Then you will confidently tell, don't worry, for 3 years you will not pay tax. He's happy. You're filing tax returns when MAT comes. You're finished. All his plans gone for a toss. I mean, don't know. I mean, he may be a manufacturing entity doing innovation. He'll be thinking 15% is better than 18%. Okay. So you may tell that MAT anyway, you'll get credit. But cash outflow is cash outflow. We are paying the tax today. Somehow you think like this, you go to the client and tell, MAT, you'll get credit afterwards. When should I pay? No. He's not happy. Cash is going out now. He's not happy. So this is one critical thing we have to keep in mind. We cannot forget MAT when it comes to 80 ISC advisors as such.
OPC can claim actually. Eligible startup means a company. Company includes an OPC.
I mean, in principle, I don't have a doubt, but I have to be accurate when I'm telling you, so I told I'll just recheck. Company, this OPC is where all it creates problem, you don't know. So I'll just park that and add this here as a point. In principle, I agree, but I would like to see some exception if it is there. There is one mistake that is there. 80 IAC, don't read as 30%. That example is ranked, take it as 25. Because in case of startup, turnover should be less than 100 crores. So tax rate cannot be 30, it has to be 25 only. So I think that column needs a rectification. So we have to take it as 25%. So the distinction is clear here, and it says when it comes to ATIAC, there is a normal tax that is there, and you can claim ATIAC deduction, but yet you end up paying MAT tax. But when it comes to BAA and BAB, you have 22% and 15%, but you will not pay MAT asset. So when you are doing projections, and tax is an important component when you do the financial planning for them. So at that point of time, draw all the three columns and plug their numbers, then only advise, okay, what is better, right? It makes it a little bit more complex once it becomes a manufacturing entity. Because for manufacturing entity, there are few more things that you have to take care, especially in terms of whether you will claim additional depreciation or not. In future, in the next year, what is based on the growth of the company, how much of machinery would be installed? Those things are very complex. Right, first day it becomes very difficult to explain to your manufacturing entity what is better for you. It is not at all easy. So there would be certain scenarios that you have to develop and plug the numbers and find out these three methods and tell which is better to the client. So this is one more thing that we have to be careful about. So this had a concern, section 5627B had a concern. So before this provision was put into place, we saw that hue and cry everywhere telling that angel taxation has come into India, and from where do we get the investments, right? So the entire thing was about the value of shares that is being issued to the person who is getting the money and at what value is getting. So basically it is about fair market value, and you would go to 11 UA and try to find out the fair market value. Normally for this it is the NAV. Now the concern we find here is when it comes to the valuation as it is, you will see a basic dichotomy that is there in the country. If something comes from abroad, earlier scenario, there was no problem because they used to tell non-resident not applicable. But then last year it got amended. Now 5627B applies to non-resident also. So it's very important, can I go through startup and see that this angel taxation can be put in control as such. So FMV is 100 and the premium that he brings in is 125. Now, very clear problem. The investor has got the money more than the FMV. So the differential of 25 becomes income from other sources in the hands of the company, right? To avoid this taxation, 56, or I should say to avoid the problems to startups, this was brought under exception for 5627B for the startups as such. And it says normally consideration received for issue of shares in excess of FMV is taxable. Post amendment made to this section by Finance Act 23, even if the amount is received from a non-resident, it is taxable, which was not there earlier. However, exemption has been granted to startups subject to the below conditions. So when we get the share capital for startups, can we have these conditions in mind? It has been recognized as a startup by DPIIT. Yes, obviously. Paid up share capital plus securities premium is less than or equal to 25 crores post fresh issue. After the issue is made, it should be less than or equal to 25 crores. However, this condition is not applicable to amount raised from non-resident and not non-resident, the AFs and the venture capitalists, right? So that exemption still exists, but for any other individual non-resident bringing in, this restriction is still there. So for a startup, these conditions we have to keep in mind as such. They don't want startups to spend more. No, I'm saying that is an illogical thing. I'm saying it will be some logic like that. So actually it should be business based, need based. But entire taxation does not go with logic and it does not go with the business needs. It goes with the economic needs and taxation targets. And see to what extent we can give but yet curtail. So entire taxation is a fight between that. That is where these problems come. So in case of valuation, the amended Rule 11 UA2 of the IT rules provides that taxpayer can use any of the following methods to determine FMV of unquoted equity shares, NAV or DCF. In the case of a venture capital undertaking, the price of equity shares corresponding to consideration received from a venture capital fund or venture capital company can be taken as the FMV as such. So there is no. So here, of course, we have some issues in the tax assessment, because when we go to the tax officer and you tell that we have adopted NAV, he tells, no, I'll go with DCF. You tell, I've gone with DCF, he'll tell, I'll go with NAV. Now the problem is, 11 UA is very clear. It is saying at the option of the assessee. But there it is becoming at the whims of the assessing officer. So this is one thing we still face in the tax disputes. So this we have to keep in mind and be careful about it. Okay. In the case of closely held company, the price of equity shares corresponding to consideration received from notified non-resident entity can be taken as the FMV. In the case of consideration received from a non-resident, these I am reading from the latest notifications that came on the subject for the valuation rules for the startups as such. So in the case of consideration received from non-resident, here is the catch, the value is determined by a merchant banker. Normally it is merchant banker category 1 using one of the following methods. Comparable company multiple method, probability weighted expected return method, option pricing method, milestone replacement cost method. I really don't know how these methods work. Honestly, I'm telling, because there are so many assumptions that are made, and mostly these concepts are those which have actually emerged from the foreign countries. Because everything that is valued there is based on an underlying asset. Finally, there is no underlying asset, right? So all valuations, many times the valuations can be vitiated. So we have to be careful there, but yet these are because over a period of time, this is the experience what the income tax department has got in terms of the valuation reports that is shared by several assessees. These have been recognized as acceptable methods for merchant banker to issue valuation certificate for 11 UA purpose as such. So there are certain litigative areas here also. Looks to be a few amended rules are trying to give clarification. So the amended rule 11 UA sub rule 3 of the IT rules provides that the date of the merchant banker's valuation report can be deemed to be the valuation date. Okay, anybody here, any relevance of valuation date? Why is valuation date relevant at all? Sorry? FCGPR, I mean, when you do the FCGPR, at that time the valuation report is there. What has it got to do with valuation date? You are saying valuation date should be prior to FCGPR. That is the point what you are saying for FCGPR. But in income tax law, we have an issue. Any valuation reports that you take, especially for 11 UA, it cannot be as old as more than 6 months. So the point is, any fresh issue of capital is happening, you have to take what is that valuation date last time you got the valuation report for. And if that has elapsed 6 months, so time has come, you have to take a new valuation report. I think purpose of rule 11 UA sub rule 3 seems to be that. I don't know where are the other hidden areas maybe. We have to be careful here again. So just be aware of 11 UA date. The amended rule 11 UA 4 of the IT rules provides a 10% safe harbor for investments by residents and non-residents. Important because if you remember, 50C had the safe harbor, where you do the registration of a immobile property and the deviation of the consideration when compared to the guideline value, which you use for stamp duty purposes, if that difference is not more than 10%, then there cannot be application of section 50C as such. Was applicable to, is applicable to the real estate transaction as such. So in the same way, when it comes to the valuation for shares as such, this has been brought into picture, which says this 10% safe harbor should be allowed for residents and non-residents. Why is the case? Because residents and non-residents is where you have 5627B implication as such. So that safe harbor has been brought in. The amended rule 11 UA of IT rules provides greater flexibility in determining FMV of unquoted equity shares. The safe harbor provision also provides some relief to taxpayers as such. This is also interesting because we feel that we have told the conditions to the client. He has got the money, valuation report is signed, valuation date is checked, everything is in line, there is no problem at all. And then the problem starts because we have not told the company what he can use this for. And he'll take that money and does any of this, then we have a problem. It says if investment is made in below assets within 7 years from the end of the year in which the shares are issued, then we have a 56 to 7 problem again. Now that leads to some complexity in the assessments as well. We'll see. Residential house, startup, buying residential house, okay. Land, building, jewelry, loans and advances, vehicles, shares and securities or capital contribution, artifacts, work of art, etc. as per clause D 4 to 9 of explanation to section 5627. So the idea is, the law is trying to tell, okay, I am giving you all the exemption that is possible. Do not put the money in unproductive assets, put the money in productive assets. That is the reason you're doing the business. So the money that you've got in share capital should go into operating expenses of the company as such. And hence, 5627B excludes these investments to be made. And now this is where the challenge is. Now 5627B, if it is withdrawn, when it is withdrawn. And is telling if investment is made in below assets within 7 years. Okay, 7th year. Okay, 7th year. Whatever capital is left, I invest in residential house. So, can we do the reassessment? Can we do the reassessment in this case? 7th year. More than 50 lakhs implication, yes. So I was thinking why 7 years? Because always if you see, you will keep thinking, okay, 6 years for reassessment, right? But then we forget the year in which we are there. That also can be included for doing the reassessment as such, as a part of the reassessment years. So, I mean, somewhere they would have connected the assessment years, and that is the reason the number 7 seems to be appearing here. I don't see an exception.
I mean, I can understand if I'm investing in land for investment purpose only, but I have a reason to do that.
Correct.
So building for that matter.
Agree. Agree. It is not that. It is applicability of 5627B itself. All the companies. Why I'm telling, I mean, this is important point for the startup, so I don't want to miss it, so I've got it here. This was a important thing, of course, at least this meets the reality. Section 79 meets the reality, because we know that it is difficult for a startup to make profits. There'll be losses, and on an average, there are many reports that are available which tells for a startup to start making profit, it is 8, 9, 10th year. In fact, it would be 10 years almost by the time it starts making the profit. Okay, so looks to be this provision is something we tend to see in our practice with startups than the profit part or ATIs. We'll see that. So the section 79, there is a catch. So the catch is that the year in which the loss is incurred, check the shareholding pattern of the company for that year. And the year in which you are going to utilize those losses, check the shareholding pattern of that company. So in case the shareholders holding not less than 51%, do not continue as shareholders holding more than 51% in the year in which the loss has to be set off with profits. Section 79 tells you lose the carry forward of the losses. The losses have to be omitted. Right? The losses are gone. This is where startups used to face the problem, because as and when the startup moves, Some of the investors who believed in the product or service no more believe it is possible. They want to exit. Some of the new investors may come and they may think that no, economy is ready for this now. You were earlier, you will make profits now. So I want to put the money now. So investor comes now. So because of the change in the shareholding, it is quite easily possible that 51% cannot be satisfied, as that is there in section 79. Very thoughtful by the government by bringing this provision to tell that although this 51% thing is not satisfied, the losses that is incurred in earlier years can be carried forward and set off with the future profits of the startups. So this is fully making sense. I don't see a problem here. Hope so. Okay. Where is the catch here? To be eligible to carry forward and set off brought forward losses, persons who hold 51%. Okay. That is the provision. Last day of the year, we have to test the shareholding. However, in case of startups, the above conditions have been relaxed to state that holding of 51% is not mandatory. And it is enough that all shareholders holding shares on the last day of the year of incurring losses hold the same shares on last day of the year when loss is proposed to be set off or carried forward. This exemption shall apply only to those losses incurred within 7 years of incorporation. So again, 7 keeps coming everywhere. So just be thoughtful of that. The next one is benefits to employees, the ESOPs in startups. Thoughtful, very important. We know that the kind of employee turnovers that happens, and from the time the ESOPs have been coined, we see it as a great value add, especially for retention of the employees as such. That in a way aroused the interest in the taxmen also to see how we can tax them. So they said, when you are granting ESOP, one where you are vesting will not tax you, that's fine. But when you are exercising it, we would like to tax the employees as a salary perquisite. So generally, whenever ESOP is exercised by the employee, there is a taxation on the value of the share that he has got, and the employee is supposed to pay tax on the perquisite. It is called as perquisite because in the course of his employment, he has got his shares. So it is nothing but the salary that he has earned. So perquisite gets taxed. Now the point is, the valuation is a different game. Cash flow is a different game, unfortunately. That is how it works. Because when it comes to valuation of a business, as I told, there are several metrics. Normally, we used to go with profit-based methods, net asset methods, those kind of things. Now valuation, the methodology in which the investor is thinking is entirely different. There would be a perennially making losses, but we keep seeing crores and crores of rupees are being invested in that startup, right? And the money is lost, but yet the valuation keeps going up. Okay, what is the reasoning? It is purely to the, I should say, the choice or the decision of the investor that he has done, the decision that he has taken that I would like to bet on this company, so I want to put more. That's all. It is as simple as that. So because of that, the valuation keeps going up. Now the point is nothing has happened. Now, based on the vesting schedule, employee becomes eligible to get the shares. He exercises the share. Out of nowhere, without a company making profit, a merchant banker issues a certificate telling that, okay, this is the value of the company. Because earliest deal that the company has made, it is 10,000 rupees per share. So on what basis the merchant banker would tell that, no, there is no value in this because it is loss? Becomes very difficult. So merchant banker, I should say, activity becomes much more challenging. He has to check all these methods. He has to check the recent transaction that has taken place and see where he can exactly place his value. Becomes a very big estimation exercise as such. Now, because of this, what is the problem? There is no cash. Perquisite is there. And it tells the value of the employee share is 1 crore. And on exercise, he has to pay 30 lakhs tax because he has to get the cash. Company is not paying cash to him, so there's no deduction, so he has to get the cash, give 30 lakhs to the company, and company remits to government as TDS remittance. That is how the entire ESOP works. Now the point is, we know how the valuation takes place here. And this challenge, a lot of startups were facing. Again, I should say, at least to some extent, it is a relief, because It says tax on ESOP shall be deferred from year of exercise of option to earliest of after expiry of 5 years or year of employee becoming, employee ceasing to be an employee of the company or year of sale. So it is taken earliest of these three. Either you take 5 years or he loses his employment in the company or the year of sale. So earliest of this they are going to tax it now because ceases to an employee important because he is no more being in the company, so obviously the TDS has to be done by the employer asset. So that is one exception here. Year of sale, very third year, he has got the money. Then what is the problem to pay the tax? Cash flows come. So year of sale. Then there is some reasonableness in the next part which tells expiry of 5 years asset. So they are given time of 5 years for the employees of the startups to pay the taxes as such. So within 14 days of earliest of these, the perquisite gets taxed and it gets included in the computation. Taxability of capital gains, no change. Year of sale of the shares as such. So I was thinking, where all the startup exemption sections I'll get. I mean, there may be reasoning in this, I'm not telling no, but then sometimes I feel this is funny. And it says, a person who has transferred his asset. I mean, I'm not demeaning this because there can be a real case scenario. I'm not demeaning this, but that I felt, one house I have, I sell it and I put it in the business. So what should be the passion of that businessman? Transferred asset, residential house property, it should be long-term, 24 months. Assessee should be individual or HUF. Exemption, investment in equity shares of startup as per ATIAC. If you are a startup recognized under ATIAC and you have got the long-term capital gains being sale of the residential house, those profits, if you go on investment in equity shares of the startup, then incorporated between 1st April and due date of filing the ITR in year in which capital gain arises, shareholding greater than or equal to 50% post subscription, very important because every person who is contributing will not get exemption. So it has to be the person who is actually taking the risk of the business who is being given this exemption as such. Eligible company must utilize the proceeds within 1 year to acquire new plant and machinery within 1 year from the date of subscription. Plant and machinery excludes second-hand plant and machinery and computers and software except tech-driven companies. Lock in 5 years for shares and new plant and machinery, 3 years for computer and software as such. So as you see, there's a benefit that is being given and every step it says, I will not give you. So that is how it is drafted. I'm sorry, that is why I told it is quite funny. First thing I felt, I'll sell my house and start the business. Next, it says I'm giving you exemption and I start reading the section. Every step it is telling I don't want to give the exemption to you. But then it is good to have on back of the mind one specific case we don't know. Somebody may fall in the category and we can use the section as such for them. This is not startup taxation. This is not startup taxation. I found it little interesting and I thought I'll just put forth before you and see what is the response. Maybe exam time for me also and let me try how this works. So there is an individual, he has got an idea, he has invented something, some new thing. He has patented it, step 1. Step 2, there is a company that he has started and it is able to satisfy the conditions that are there in DPIIT definition as such for startup. So assume startup definition satisfied. So over a period of time, he is able to generate good value in the company, right? He is able to make profit. I mean, he is the major shareholder, whatever it is, okay? He is able to get funding, fine. He is still holding significant shares, etc. Now the point is, the entire invention, which became the basis for the company to sustain and do its business, somewhere during the course of the entire business, we tend to forget. Now the point is, he'll tell, boss, you told me form a company, I'll give to you IT, ISC and all that. I mean, nothing came to me as such. At least give me something which saves my tax. And probably you go on to telling that it is your invention, you have patented it, you have allowed the company to use it, now transfer it to the company. Value it, because the company might have done good turnover now, it might have reached some good profit and values. Based on that, quite possible the patent value can be quite large. So instead of taking the money as dividend, quite possible he can take it as patent transfer. And in his hands, 115 BBF tells the tax rate is only 10%. Point number 2, patent becomes cost of the company, capitalize it, it becomes a intangible asset, claim depreciation at 25% every year in the business as such. Now, out of nowhere, you've got an income to him, got him a very less tax rate, you put it as an intangible asset, and that depreciation over a period of 4-5 years, on the patent cost, you have again saved some 20 to 25% of tax. Possible, real life scenario, in few cases this may be possible, I think we can explore. I hope my assumptions were right. Anybody wants to challenge? Works? Works? Doable scenario? Think can happen in business? I think we have to be thoughtful. Somewhere we think, okay, some patent is there, how do I relate it to startup? I think we have to draw the line somewhere and see if somebody can benefit.
When you're applying for registration of this patent, won't it create any obstacle whether the company owns it or the individual owns it?
Individual owns it, that is very clear.
That's fine,
But then, whatever you,
calling it an IP, right? It's an intangible asset in your books of the company.
no,
The person
no,
registered.
no. When the company,
You said depreciation, right?
later, that is step 2. Step 1, individual is owning the patent. It is my company, I will allow the company to use it. Commercial expediency, initially yes, I don't want to charge royalty to the company. It is my own business. Why will I charge royalty to my own business? I don't want to charge. So I'll let the company flourish for a period of time. Then I decide the patent that I own, I'll transfer it to the company. Then I derive an income which gets taxed at 10%, and then the depreciation part comes. So I'm talking about step 1 and step 2. We'll go in this sequence. Any problem here? No? Pass the test. Okay, I was just thinking about it, I thought of bringing it. Of course, when we actually advise the clients, we'll do a few more assumptions, put the computation, see are there any other problems there. Because, I mean, 48.2b straight away comes. 48.2b may not come, there it is expenditure. This is capital expenditure. Again, we end up reporting it though, because 48.2b in the tax audit, you have to report related party transaction expenditure. So it comes there. But as long as valuation is defendable, why not? Why not? No, it says tax on royalty received on patent developed and registered in India, tax rate 10% on gross amount, available only to a resident. 5 years lock-in, withdrawal leads to 5 years of non-availability. That is, in case there is a withdrawal of the patent, in those cases. And of course, the Form 3 CFA. Indirectly, one more section which may get connected to the royalties, 80 RRB deduction. So in the first place, very small amount, but then section is there. So I'm just trying to explain. It gives deduction of only 3 lakhs, not something very big. Because, but if there is royalty income to the person who has given the patent to the company for usage and getting royalty, why not claim 80 RRB? There's a 3 lakhs deduction there. So I'm saying inside the law, there are few points where it is possible some tax may come out. We may not exempt the entire thing, but some tax may still come down. For startups, again, few tickling issues may be there. There is an existing shareholder, he would like to get more money, right? And he says, I became a shareholder in your company 3 years back, you want more money, I'll bring it, but you are going to give it to me based on the shareholders agreement that we had, and I will exercise my right to buy the share out of a rights issue that you're going to come up with your company, right? Part 2, the condition 2, I will not pay you the current valuation, I will pay you the value that was prevailing 3 years back. Now the point is, in case of 56(2)(10, normally it says, in case you acquire an asset and that asset you acquire less than the fair market value, the person receiving the asset has to pay tax on differential of the actual FMV minus the price at which he acquired that asset. Becomes income from other sources. In that case, what happens to rights issue as such? So we had this Gujarat High Court PCAT versus Jigar, Jashwantlal, where it says the court distinguished between creation of shares and their transfer, leading to the conclusion that this provision should not apply to fresh issue of shares by a company. So 56(2)(10 normally talks about transfer. Transfer is some asset that I possess, that I give it to you. But here, the company does not possess the shares. It is creating the shares and allotting to somebody to get the money. So hence, 56(2)(10 should not be applicable to rights issue as such. Litigation can still happen, because we know as and when the value of the litigation goes up, final eventuality is it has to go to Supreme Court. This we were able to get at Gujarat High Court level, so I have quoted here. But quite meaningful, because we are not talking about transfer of asset here, it is issue of the shares, and hence 56(2)(10 should not apply. But Sudhir Menon case, we have got disproportionate non-uniform allotment under rights issue can attract section 56(2)(10, especially where there is assignment of rights in favor of other shareholders. Right? So this is from Mumbai Tribunal as such. So in the same slide, you are able to see the different treatment by different courts as such. You have to keep in mind, but to my knowledge, I think this can be fought, because it is not a transfer of an asset, it is issue of a fresh share. So hence 56(2)(10 should not apply. That is my personal view. I feel it can be defended. Same thing, bonus issue. Possible that a startup doesn't want to give the dividends. The existing shareholders feel that we don't want the dividends, give us more shares. We want to have more shares of the company. So you convert your profits and give them as bonus. Karnataka High Court, Ranjan Pai case, bonus shares merely reallocates company's funds, section 56(2)(10, 56(2)(7, earlier 56(2)(7 ruling, I am trying to apply for 56(2)(10. Karnataka's High Court judgment is in relation to 56(2)(7, but it is on par with the scenario that we see in 56(2)(10 as such. So we feel it can still be applied. We can tell it is inapplicable sans transfer of property, because it is again bonus issue. What shares I have as a company I am issuing, I am not transferring the shares. So bonus issue also has to be kept out of the tax net as such. Okay. I thought there can be many more. For example, you can tell, okay, how do you interpret section 35, scientific research? I mean, there can be many more sections that can be added, but I thought for the time that we have, this we can see, and there is nothing wrong in going to each of the deductions and saying how we can correlate this section to the startup and see if our client can get that benefit. I think that is something that we have to sit with pen and paper and try to see what benefits they can get. Now, next is on financial planning. Not a very great expert on financial planning though, but I'll try to do justice to the topic as such based on the experience that I've gathered over a period of time that I've been with the startups. I've worked with startups right from 2006, 7, 7, 8. I've seen their cycles, many falling, many going up to very high values as such. So from that experience, I'll try to see what experience I've gathered, I'll tell you. Not the real financial planning probably that we learn in second paper in CA final. Not that kind of a financial planning. Let's see practically what happens and what happens to money. Okay. Key considerations. We tend to give the advice based on what we see in the books of accounts as chartered accountants, correct? There is a capital that has to come from the foreign entity to India. The guy is investing 10 crores and he's getting it as capital. So we are seeing what is the valuation that has to be done for FCGPR purposes, for the income tax purposes, whether it is a startup or not, all those conditions we have seen. And he gets the money and it is lying as capital. And fellow is not spending that at all, because the investment that he needed to make in the business for 1 crore, that was for plant and machinery, assets and rental deposit. Rest of the money, why did he get as equity capital at all? How will you take back 10 crores now? Even if you do a reserves of next 10 years, some 20 crores reserve you have got, the company law tells every time you can do only 25% as this one, and then between two buybacks there should be 12 month, 18 month, whatever gap, right? No, we can't take out the capital also. Everything is stuck. So the point is, we are advising the client and telling what is required under company law, what is required under income tax law, and we are not telling, boss, you get 1 crore as capital, balance 9 crores, you keep with you. When we require for every 3 months or 6 months, if you have billing back to you, we'll take it as transfer pricing advance, something like that. Or if you feel that there are other operating costs that has to be met, we will get more operating revenues later and we can return it. Possible, we'll just take it as a loan. Of course, there is a pain in the form of ECB. There are, compliances that have to be done, which is painful every month. I understand. But then 9 crores, how will you take it back later? Better to go with RBI and face all the trouble and go with ECB and keep certifying every month, right? Do all the compliances, than getting stuck with 9 crore of capital and not able to give it back. So are we thinking about how much capital did our client get for his business? Is that right? Type of investor, align goals and values with the right type of investor, whether they offer mentorship, industry experience, or simply financial backing. Because investors can be many types. Investors can be many types. Of course, I think from investment side, if somebody has already spoken, I would not take this point. I think we can go to the next. Correct? I think you already know that on the investor part. Okay. Equity versus debt, I already explained. Control and dilution. So the point is, a new investor is coming and is giving the money. You know that your client is in dire need of money. Correct? But the person who is coming in tells, give 49%. Or he tells, give me 50. Or he tells, give me 26. You know, back of your mind, okay, where exactly it is affecting the board of directors or the shareholders functioning in the meetings, right? Based on which, say, special resolutions can be blocked. Are you ready to take that risk? So let the client be aware, you would give this kind of a dilution, this is the risk you're going to face in terms of control and dilution as such. Exit strategy, have a clear vision for how investors will eventually exit their investment, whether through acquisition, IPO, or other means as such. Many times it so happens, they've got the money, they feel that, okay, let me invest. The point is, you go invest and buy large value assets. Later, it will lose its value because there is depreciation. Your business is still in testing stage. You don't even know whether you're going to grow the business or you're going to be successful in the business. So in that case, why purchase the asset? Take it on lease. Wait. And at the exact time you feel that, okay, I can buy it, at that time at reduced value, buy it. No problem. Lease cost is high. That's fine. Better to pay 10 lakhs than paying 10 crores. So initially it is not just operating cost, making it profitable and all that. Lot of things finally boils down to cash flow management. If the entire vision of the business is after 5 years or 6 years, it is going to make profit. And by the time it starts making the profit, there's no capital in the company, it does not make any sense at all. So that cash flow management becomes very important. I mean, I thought there are several other conditions based on which this decision can be taken. Very important. Work from home or work from office. Especially if it is tech, they have already understood. So they have gone with work from home. They are able to save very high rental costs. And we know how the rental costs would be. They become very, very high. And those kinds of, real sunk, these kind of costs is what brings down cash flow and profitability of the company. So if the promoter is confident he can get the work done, why can't get the work from home done from the employees as such? Of course, there are some challenges. How do we maintain company culture? How do we define their roles and responsibilities? They're not seeing each other. There are no employees to see, but yet I am an HR. Oh, I am an HR. I'm not able to see anybody. I'm still an HR. So then, of course, comes the working capital management. In several of the startups, somehow this happens. It has become a trend. They want a very trendy office. They want all the indoor games to be there. Every 2 hours, there should be something available for eating. And we are thinking as and when people get energized, they do more work. But unfortunately, when they get more energized, they get carbs also, they sleep. Our food is being distributed daily like some function. I think that is what I feel. In fact, they should tell, when you joined the company, this was your BMI. After 1 year, what is your BMI? Based on that and your turnover achievement, we will fix your next increment. I think automatically startups will start conserving cost and cash. This is the way I think the HR should do the performance management as such. Of course, there may be excess funds because they're not able to budget properly. So where are the funds kept? If you feel it is risky, obviously it is risky, so you would avoid all the equity funds or the equity share investments. To a great extent, still possible, I think, unless there are some stray cases, otherwise debt funds have been for a long term being safer. And of course, you'll tell them keep it in FD, I'm not telling no, but then that element of risk is there to keep it in debt fund. Why not use it? There are several kinds of debts and all that I've explained here. I think that will be there in the presentation. More importantly, on the financial planning side, what should the promoter know? Promoter always feels his idea is there, that is going to take him ahead. Fine, but there has to be money in your pocket, otherwise you can't do the business. So for that, the businessman has to be alert. As chartered accountants who provide him services, whether on compliances or accounting or MIS, I think periodically on a monthly basis or quarterly basis, based on the appetite that he has got for numbers, why not give this to them and tell them, ability to understand financial statements. Is he able to understand if I give balance sheet, if debtors it is showing like this and creditors it is showing like this, what does it mean? He is not know between debtors and creditors, whatever difference is there, his working capital is blocked because debtor is not paying so much of money. So he must be able to think, okay, I have to see if I can get more credit, but yet not pay interest on that, and do a better negotiation with my creditors and try to get my money faster from the debtors. Can I reduce the gap so that cash is more in the bank? Now the turnover can go up because that can go into inventory or in the operating cost as such. That working capital, have we taught him? Simple, these 3 lines also many times we might have missed doing it. I think that is what we should tell them to the startups. Need for MIS, it should have balance sheet, profit and loss, water flow statement, cash flow. This water flow statement, these are all some jargons that comes from the investment community. And it says, okay, take your cash and see first it flows how much to your capital, then how much it is flowing to your other operating assets, then for inoperative items. So there's a water flow statement that comes, those kind of reports you can tend to make. Cash flow statement, can you make a decision matrix? In certain situations, whether you should pay so much, not pay so much. Can there be a decision matrix within the accounts payable, tell that, okay, up to 10,000 rupees or up to 1 lakh, I'll not go into this, or up to 50,000, I'll not go into it. Beyond this, I'll see, so that I have sufficient control on money also. I have control on what business I have to do. So I'm standing on both the parts of the business as such. Valuation. So many times he would be talking about, say, diluting the stake or selling his stake, etc. People would come from all backgrounds, and the value that they tell, we don't know from where it is coming. So can there be some suggestions from our side telling that, okay, let us see in this valuation, can we defend your business? Right? Finally, on the negotiation table, if you're able to back your numbers, many times it is possible the deal may go through. It is possible. So as long as the valuation method that we have used, the basis that we have formed, and we're able to the table and show it to him, this is how you should run your business. This exactly we know as CA firms, because apart from this business, we see 100 other businesses. And we always learn from best practices. We should share them here. This I saw would be some of the terms which we must be aware. Because when we are doing financial planning and somebody is talking about it and we're not able to catch it, looks like we missed something somewhere. So it says runway. When they're talking in the terminology, it says time left before startup runs out of money. So somebody is telling my runway is 3 years. You're telling, what is it trying to tell? Okay. Burn. Burn rate. Rate at which startups spend their working capital. Churn rate. Change in stakeholder base. Stakeholder base, how fast it is churning. It is slow, it is fast. What is happening? Customer acquisition cost, CAC. So how much cost that I have to incur in form of free buys, discounts, some flash messages, and those costs, and get an additional customer. So additional cost I spend, additional customers I got, additional customers divided by additional cost is your CAC. So I'm saying, how will you reduce CAC or increase CAC based on need of the, I'm not talking about whether you reduce, increase, I'm only talking about concept, but we must be aware. Customer payback period, the time within which the CAC is recovered from the customers. He became customer, I spent on him 1 lakh, but every time he gives business to me, he's paying only 1,000 rupees. So I have to transact with him 100 more times so that the acquisition cost I spent on him, I get back. Customer payback period. Term sheet, non-binding agreement that provides details of terms and conditions without getting into minute details. Term sheet is normally I should say invitation, the first step towards investment, acquisition or anything, which tells, okay, on these terms, can we look at investing in your company or you selling your shares to us? Later it transpires to, say, sale agreement or shareholders agreement, share transfers agreement and all that, but everything starts with term sheet as such. I thought few things we can know before we conclude, and thank you for this. I thought I'll keep it crisp, and whatever is possible in 1.5 hours we can manage. I hope it is purposeful. Thank you.
Members, we have come to end of last session for the day. Whole day, all the 3 sessions, we have learnt what is startup in brief, and then how do we get funding, and then how do we think as an entrepreneur for that particular startup. Yeah. Before vote of thanks, an announcement. We have dinner arranged at the basement. Kindly make it convenient to have dinner and then leave. Yeah, and then we learnt how do we build a strong foundation with regards to legal aspects and operational aspects. And now with the KL Prashanth sir session, now we learnt how the startup should do tax planning and financial planning also. Members, this session was thought-provoking with regard to tax planning and financial planning. Thank you, CA Prashanth KL sir, for that wonderful session. A round of applause for that wonderful session. On behalf of members present here and all the managing committee members of Bangalore branch, we would like to thank you, sir. We would like to hand over a memento to the speaker as a token of gratitude and respect. Can I request CP Jain, our MC member, to come out to desk and then do the honors. Thank you, sir. Thank you.